Hi, everybody. Thank you so much, Brian. Thank you to Hardman and Co. and GrowthInvest for having us today. It's good to see a few familiar faces. But if you don't know me, I'm Olivia Drinnan, and I'm responsible for Advisor Fundraising at Haatch. If you don't know Haatch, we're a sole EIS and SEIS fund manager. So hopefully right on the money with the topic today. Quick risk warnings, which I'll skip through because we all know it's high risk and not going to be familiar for not going to be appropriate for all clients. To tell you a bit about Haatch, I think it's best to start right at the beginning and kind of how we hatched or how we were founded by the two founders on the screen. We were founded in 2013, so it's Scott on the left and Fred on the right. And it was really founded because they are themselves repeat entrepreneurs. So they're business angels. It was really driven by their own frustrations as entrepreneurs, raising capital by investors, but maybe not having their own entrepreneurial backgrounds and ability to help them scale and exit. So they actually have worked together in two previous businesses, actively combined over £100 million worth of exit. So Kiddie Care, some of you might remember that company. It was actually sold to Morrison's Supermarket for 70 million. It was a tech-based pushchair business. It's kind of like a bit of a competitor. I think it's Mother Care that we have at the moment. Haatch is really all about how our founders have really kind of grown together. It really does help that they're super close to the industry. So Scott is now a board member of the King's Trust, which it is now. He received his own funding for them when he started in Kiddie Care, which is a really nice round circle moment. He's awarded an OBE in 2022 for services to tech and retail e-commerce entrepreneurship. And Fred on the right is a board member of our industry body there. So both really connected to the industry. Now, our design team has gone a bit wild with this slide, so I'm not going to go through every single stat that we can see, but the key message with Haatch is that we are in an incredible rapid growth and scale stage. So if I was speaking to you this time last year, I would have been saying that we have raised about 50 to 60 million pounds, whereas we're now over the 100 million raised mark. That's just how we calculate our AUM. I'm literally having to update this slide weekly as our investor numbers are soaring. The portfolio value figure in particular, that keeps on going up. We're on about 1 billion now. So I think if you've not come across Haatch before, now is really the time to meet us. We're really becoming a key industry player and one that your clients will be familiar with and hopefully bringing up. And I think the reason to that boost is because of three key things. So Brian kind of just alluded to this. We've had a lot of recent successful exits. So we actually had 5 just in 2025, last year alone, all of those profitable, all of those returning funds already to investors. I'll talk to you a bit about some examples of those in a minute, but really high returns and past the 3-year mark, which is really important. The other thing that I think clients really like about Haatch is that we're fully backed by a government-owned bank. So that works really nicely with these schemes, obviously being government schemes. So we're backed by the British Business Bank. If you speak to Scott, he will tell you that the amount of due diligence that we had to go through to receive this funding was mental. It was more than anything that he had to go through selling Kiddie Care to Morrison's, literally 3 years of intensive research into our investment thesis and then some. But we were awarded this and it keeps on going up. We're on 27 million pounds. From your perspective, what that means is that every time your client invests, a British Business Bank money or government money will go in alongside the client. They really like that for that institutional validation, the kind of confidence in our investment decisions. From our perspective, especially in SEIS, where we're restricted to 250k per company, that's a government legislative rule, we can actually deploy more money. We can deploy more, like £330,000, because we have this additional British Business Bank money, which means we can be more competitive in a very, very competitive space. And cool to see that some of my peers in the market also offer fast deployment. We love fast deployment. We like to get your money working. We're working on around 2 to 3 months deployed. I'll talk to you a bit about the funds that are currently open and will be deploying in this tax year. And this is kind of cheeky of me to include, but I'm obviously going to include this really nice quote from Hardman and Co. from the last review, who referred to us as the best established S/EIS manager of its age. We're just doing another review now, and I'm a really big fan of these, a really detailed account, so I'll be sharing that with everybody when it comes through. What we invest in is super broad. So business to business software companies, but actually it's more sort of tech generalists. So I'm going to break this down for you. The reason that we like B2B is because we like recurring revenue, long-term contracts, the kind of companies that are earning money whilst they sleep. That is really helpful when it comes to exiting businesses, especially if you're going to sell them, if they're going to be acquired. And that's where investors make returns. We also lean towards software as a service, or you might hear people call it SaaS, because once the software is built, there is little incremental costs. If you think, I've got a software, I've built it, then I just need to download on everyone's laptop, maybe support them through using the software, but I don't have to, have offices or additional staff members across the globe. So it is a very scalable industry, which I think reflects some of the fast and high exit returns that we made last year. It's also really diverse. There is no industry that I can think of that doesn't rely on some sort of software. Nowadays, we're all using software right now, for example. So we've got about 40 plus sub-industries within our fund, really built for scale from day one. The thing that makes us different, and we're super picky on, is that the companies we invest in have to solve some kind of what we call a pain point. If you speak to Scott and Fred, they'll say the kind of pain that keeps a company up at night. So we're backing software or tools that companies become reliant on, that kind of really sticky software that'd be a nightmare to remove or replace, and saves you time, cost, or risk, or ideally all three. A great example of this is one of our companies that we exited this year, or last year, I need to start saying, now we're in 2026, is a company called Reflow. So they are a construction industry company. They exited for 6.5x in 4.5 years. So VCT beating timescales, really good returns, exactly where we want to be. But their software basically helped in the construction industry builders upload pictures of the progress from building a home. It's a lot more complex than this, but I'll just keep it simple for the story, for the good story to repeat to clients. But what the issue is in the building industry is that there's a massive kind of disconnect between the field guys and the office team. And this creates a lot of cost and also a lot of compliance and safety risks. This kind of software allowed office managers to keep the field guys accountable, but also it's reducing safety hazards because the software can immediately identify risks. So you can see that once that is implemented, how reliant these kind of companies will go. And obviously it just took off in a really short period of time. To tell you a little bit about the different funds we have. So we just have really simple 2 funds, our SEIS and EIS. They're both evergreen, they're both open all year round, but we'll deploy these in tranches. So if you just speak to us, we'll tell you what's open at the time, and we'll tell you when it's due to close and when roughly it's due to deploy. Our current SEIS fund, so this is early stage, as Brian mentioned earlier, although we do as a company lean towards businesses with some reoccurring revenue at this point. But this is our current raise is open for deployment in the next tax year. The thing with our EIS is that we have a 4 million hard cap, and this is designed to preserve the quality. There's a much wider pool of companies available at SEIS stage, and we're more restricted to what we can invest, obviously the 250 cap. So at the moment we have 3 tranches a year, 9 to 15 companies, but the last 4 tranches we have reached the 4 million cap around up to a month early. So assume that it will be 15 companies within that tranche if you would like to invest or recommend. If you are thinking about investing in the current tranche, although its deadline is April, we've already raised about 20% of this tranche, so we're expecting it to shut in about March. So if you would like to reserve allocation, please let me know ASAP, and I will arrange that for you. Our EIS is later stage. So we say it's an absolute minimum that these companies should be raising K annual recurring revenue. In reality, it's much higher. So our last tranche, it was average about £1 million annual recurring revenue across the companies. And it's made up of our top performing SEIS companies and new EIS opportunities. But those new ones are co-investing with really world-class tier one investors, the global names like the ones that you can see on your screen. EIS is uncapped because the companies at this stage can responsibly absorb more capital as they scale there later. And we typically invest in around 4 to 6 companies, progressing towards Series A or B. And the idea is that we're either doubling down on our current companies or attracting world-class capital in companies with an already strong record and a clear route to exit. So our current EIS tranche is open for investment for deployment in this tax year. We'll be shutting it right at the end of March, and we'll be deploying it before the 6th of April, I think it is this year. So that'll be a fun week in the office that I will avoid like the plague. Some examples on the screen of some unrealized returns. So we strip out our return figures down to the kind of bones. We don't put any tax reliefs in there. And these are all based on formal funding rounds, not independent valuation. So it's the market standard. You can see some really nice numbers. Obviously, if you're looking from the left to the right of the screen, starting in 2019, the numbers are going to be higher there because we've had more time invested. So as companies have had more time to grow. But some great examples, even in 2024, Beings, for example, Augmented, we only just invested in them at the end of 2024. So it's just been over a year already seeing really nice growth on those multiples. Here are the two kind of biggest exits that we had last year. So we had SEIS exit in a company called Native Teams. Would love this example because it's quite a simple problem that they just identify by experiencing it themselves in their own companies, created a software to solve it and scaled and sold it 0.4x in 3 years and 2 weeks. So this was a company who basically identified that it's an absolute pain for people hiring remote workers that live in different countries to pay them to do it all compliantly, and their software solves this entire problem, and it just took off in such a short period of time. The reason that we kept it, that we deliberately held it for 3 years and 2 weeks, is because you have to hold it for 3 years to claim your tax release back. So all of those investors got 7.4x on their return and all the tax release that they used going into the SEIS. So it's actually probably more like 12.8x if you include just the income tax relief there. And Reflow, we've talked about, a great example how we've invested in a company twice because we saw it had a clear route to exit. We saw the possibility of it for our investors. So those second round of investors still got really good returns, 4x in 3 years. But the first ones with the FX, I got the significant returns. Obviously, I'm talking to you a lot about the good and the amazing things at Haatch and all the companies, but we like to be super transparent. We are in the world of venture, and if we don't have losses, if we don't have failures, then we are probably not taking enough risk. So some examples of failures on the screen here, various reasons. Every time we have a company failure, and we class it as a failure internally, even if it exits at a partial loss, we have a big company meeting. We go into the detail of how we could have prevented it, if any, or how we can avoid these in the future. I think some of these are because our thesis has changed. We previously invested in B2C. That's not our area. That's not where we see significant growth. It's allowed us to refine our thesis and really focus it in this space, which is delivering. And this is where we're expert in. So out of 174, when I last checked, investments, we've got 10 failures so far, and that number will keep growing. If you're going to invest in SEIS, 15 companies, we do not expect all 15 to do 7.4x. But it just takes one big one, for example, that Native Teams exit, and that's a fund returner. So for those investors, which I personally had the opportunity to ring some advisors and tell them the good news, they returned the entire fund in just one exit. So a really nice story. to pass on. We don't have any hidden fees. We charge an upfront fee of 5% and an ongoing of 1% for 5 years. It's kind of a bit optics there. It's essentially the equivalent of 10% upfront. That seems really high, but GrowthInvest actually did some amazing research for us. And we're coming out in one of the cheapest in the market. We really do not want to charge our investee companies anything. We find that we're very competitive, and also because we're investing alongside tier one investors who do not charge anything to these companies, it's really important. So we have that just solid initial. We don't have any hidden fees, dealing fees, additional admin charges until we've returned 100% of the capital. So that's without the fee included. So if you invested 10 grand, we won't charge anything until the full 10 grand is returned across the portfolio. And then after that, we will charge 25% if we return over 1x and 30% over 5x. We're all motivated as a business to return those X. We all bonused on that amount. So hopefully that's nice, short and sweet. This is the team. Please feel free to contact me. We're all really contactable at Haatch. Our emails is nice, simple. I'm Olivia at Haatch with 2 A's. Or someone said it's like how Jeremy Clarkson would pronounce Hatch to me the other day. Hatch. So I'd love to hear from you. Thanks, Brian.